How's it going, everyone? Hope you're all having a fantastic day. If you're new to the channel, welcome. My name is Nick. In today's video, I'm going to be going over 7 stocks that I see as phenomenal long-term buys if they get to certain price points within the month of August. This is my party shirt, and I wear my party shirt when I hit milestones. I recently hit 500 subscribers, so you know what? I forgot to do it in the last video, and you know what? Here it is now. So thank you very much, everyone who's following me. I really do appreciate it. Anyways, you're gonna have to put up with this awful shirt that I found secondhand from some store. So before we start, if you could absolutely disintegrate the like button, I would appreciate it. That's the most cringiest thing I've ever said in my life up to this point. If you could also subscribe, that would be very beneficial for my channel. I would appreciate it. I'm going to be doing lots of videos like this, EV stocks, tech stocks, IPOs, everything personal finance to help you grow your wealth. These stocks are in no particular order, and make sure to do your own research before purchasing any stock. Don't just take my word for it because I'm saying it on the internet. All right, now sit back, relax, buckle up, and let's do this ride. Alrighty, let's jump right into it. The first company I want to talk about is a fascinating company founded in 2014, headquartered in the United States, and focused in biomedical and genetics research. This company is called Intellia Therapeutics, under ticker symbol NTLA. So Intellia Therapeutics is positioned within human genome editing, and this may sound intimidating to you, but instead of changing, your hair color or your eye color, instead Intellia Therapeutics is using this technology they have designed to challenge currently incurable diseases. Gene editing is currently in its infancy, and companies within this industry are poised to potentially make immense profits. Although the space is very new, the industry is already relatively crowded, as companies are realizing the insane upside to gene editing technology. Intellia Therapeutics is really positioning themselves well in this future landscape, and they are starting to emerge as one of the front runners for certain genetic disorders, such as hemophilia and sickle cell anemia. Essentially, they are a gene editing technology company positioned in the CRISPR-Cas9 system. And I do have a science degree, so I know exactly what that is. So bam, don't be going in the comments, oh, you have no idea what CRISPR-Cas. Yeah, I do actually. They are taking this CRISPR and implementing it into the human genome. They can essentially go into the human genome looking for mutations that result in diseases, snip out those mutations, and replace it with the correct set of genes. Intellia currently has 10 products down its pipeline, and they're specifically targeting blood disorders, as I said before, hemophilia and sickle cell anemia. These diseases are currently incurable. However, Intellia Therapeutics has seen very promising laboratory results. It's important to note that Intellia Therapeutics has not yet reached human trials, which does present some innate risk to the stock. Looking at their stock price, they have had a massive valuation surge beginning in about mid-March until early July, up more than 164%. They're quite a volatile stock, as we can see from the graph, and I'm hoping they can come down to about the 13-14 price point, at which I could see Intellia Therapeutics being a very good long-term buy. Have a market cap of 1.09 billion, so they're a small cap company, have a pretty decent price to book of 3.97, and don't report a PE as they've reported negative earnings. Along with their CRISPR-Cas9 system, this company already holds lots of intellectual property that they can leverage as capital in their future if they choose to do so. Going through their balance sheet, we can see a net loss of 31.8 million, a total operating expense of 46 million, 250.3 million in cash. This provides a nice cushion that they can use, getting them through at least the next year if they run into any liquidity problems. They're projecting a negative forward EPS consensus of negative 0.69. However, they are in such a unique position for the advancing technology in the biosphere, and I really like this company long term. They are doing incredible things, and I really do think biotech and genetics is an undervalued industry currently. As I said before, it does present some risk as they haven't entered human trials. They may enter human trials and realize that none of these products actually work as they are supposed to, setting them back. There is also the possibility that they will get scooped up by some larger big pharma companies such as Pfizer or Merck, in which case they will be bought out, increasing the stock price to a capped amount. However, it would be a nice valuation surge. The future potential of CRISPR in pretty much any sort of system is phenomenal. This is going to be the future of gene editing, and I think we can use this system in the coming years to our advantage. All right, moving on to one of my favorite stocks I own. It's, I think, my second biggest position in my own portfolio. It's one of my favorite stocks. It's been steady Eddie, and I can see it only continuing on this nice trajectory for the foreseeable future. This is a company you're all aware of, the OG, Microsoft. All right, so we all know who Microsoft is. They have an incredible management staff. They are continually innovating. They have performed year after year after year. They pay out a dividend even though they're a tech company. What's not to love about them? And what's most important is that they are continually positioning themselves for the future landscape. Their Q4 revenue grew by 13% to $38 billion year over year. Their operating income grew by 8% to $13 billion, and they beat out analysts in terms of revenue, earnings per share, intelligent cloud, and personal computing. They are an extremely diversified company. They have tons of cash on hand, and they can essentially outcompete all of their competitors, and if they can't outcompete them, well, they'll buy them. As our world continually moves online, Microsoft will only benefit from this, and in the current health situation, gaming and their Xbox console is going to really see a surge. What most people don't associate with Microsoft, I think, is their Azure component. This generated up to 35% of their revenue last year, and this is only going to increase in the coming years and decades. As more and more companies move online, Azure is able to take all this in and store all of its software in its 61 global divisions. In regards to the global health situation, Xbox is extremely well positioned to benefit, unfortunately, from this situation with their Xbox console. As more and more people are forced to stay inside, less places to go, more people are looking for entertainment, and many are finding it through Xbox. Xbox and related content services are up 65% year over year. As I've said before, I think it's so important that they pay out a dividend. It shows they really care about their shareholders. They don't have to be paying out this dividend whatsoever. Tech companies nowadays really don't ever pay out dividends. They know they're going to attract investors regardless. And what's more is that Microsoft has increased their dividend in a consistent way over the decades. Microsoft has an extremely strong balance sheet. They have a market cap of 1.5 trillion, a decent forward PE of 32.26, 12.96 price to book, a whopping 40.14% return on equity. They generated 143.02 billion in revenue. They have a low beta of 0.93, have a gross profit of 96.94, have 136.53 billion in cash. They have a great ratio of 2.52, indicating more assets relative to liabilities, and have a nice forward dividend of 2.04, which is actually extremely generous considering they are a tech company. I'm going to keep this stock, I think, for the rest of my life. This is a great long-term buy and hold. They're steady Eddie, they're not going anywhere. They have a great management staff, and I can see them really increasing in capital gains in the next coming years. All right, number 3, staying within the same sphere, the next company I want to talk about is Activision Blizzard. Activision Blizzard, if you don't already know, is one of the biggest video game developers within the entire world. They own everything. They own Call of Duty, the best game, one of the most popular games of all time. They have a foothold in the esports world with their Overwatch League. They own World of Warcraft. They are extremely well diversified in terms of video games. Video games has surpassed the movie business in terms of revenue generated. This is insane. It's growing in importance to a lot of people, and especially in this day and age, during this health situation, this is only going to keep increasing. More and more people are staying inside and looking for things to do and finding things to do in the form of video games. They have a market cap of 61.631 billion, a beta of 0.61, a PE of 39.58, and are set to release earnings on August 4th. If you want to play it safe, you could wait until after the earnings report has been released to see if they are a buy. You might see a little dip after this earnings report. However, I would suspect a fairly decent report for them, so you could see a valuation surge. They pay out a small dividend of about 0.52%. However, it's better than nothing. They have a profit margin of 24.19%, a return on equity of 12.68, 5.98 billion in cash, and a current ratio of 2.78. They're sitting at a 1.9 between a strong buy and a buy. I really like this company. They have a great management staff. They're well diversified. Video games are increasingly being used by the general public. Analysts like them. They have a very strong balance sheet. More and more people are playing video games. Esports is only set to increase in the coming decades. I really like Activision Blizzard. Well diversified, strong video game company. Who doesn't love pets? If you don't love pets, you can Get out of here. Actually, no, don't. Just stay and watch the video. You can just let me know in the comments if you don't like pets. That's fine. Please stay. I really love pets. And when I mean pets, I only mean dogs. I'm not a cat guy. I'm only a dog guy. More people are staying home. More people are working from home. People aren't traveling as much and are looking for sources of joy in a very dark world. People are looking for that extra dopamine, the serotonin, and they are finding that serotonin and dopamine in pets. Who said money can't buy happiness? You look at a dog and tell me you didn't just buy happiness with that money. You did. Dogs are the best. Please follow my other channel. Nick talks about dogs and dopamine and serotonin for 4.5 hours. I'm joking, I don't actually have that channel yet. If you own a pet, you're probably aware of the company Chewy. They are an online retailer of pet foods and virtually all things pets you can think of. They completed their IPO in 2019 and raised $1 billion. They have a market cap of $18.456 billion, have a negative EPS of 0.65, don't pay out a dividend, have a negative profit margin, have $192.53 million in cash, and have a current ratio of 0.61, indicating more liabilities to assets. Their statistics clearly aren't great, but what's important here is their increased trajectory in revenue every single year. They are really ramping up their revenue year over year. However, their exceedingly high cost of revenue is really chewing into their bottom line. In the trailing 12 months, they generated $5.3 billion, resulting in a profit of $1.26 billion. However, after operating loss, ended up with a net income loss of $270.686 million. They currently sit at a 2.1, very close to buy, with an average price target above their current price. Because they are positioned online, I don't think the current health situation is going to affect their bottom line much more than it already has. And with more people working from home, staying home, I really can see an increased amount of people purchasing pets for that serotonin and dopamine. All right, moving on. The next company I want to talk about is a great, fascinating, innovative company. I really like them. They've blasted onto the scene. They're taking names. It's a company you're probably aware of, Beyond Meat. All right, so Beyond Meat was formed in 2009, and they are a plant-based meat substitute. With the current health situation taking a massive toll on the meat packing industry, and with the health situation projected to increase in the coming months, I really can see Beyond Meat taking a higher precedence in our current situation. Many people are also realizing the eco-friendly benefits of choosing meat alternatives such as Beyond Meat. I'm not giving a climate change TED Talk right now, so I'm not going to go into the details of why our current situation is damaging our environment. We are slowly but surely seeing a shift in the way people consume meat and meat alternatives. Going to their statistics, Beyond Meat is a very expensive stock, currently hovering around 125 USD. They are down about 46% year over year and are slowly but surely coming into buying range in my opinion. They are down almost 12% just this month, and if they reach around the $90 to $100 mark, I can see Beyond Meat being an extremely lucrative long-term buy. As the markets recover in the coming years, restaurants begin opening up in the coming years, Beyond Meat is going to surge in valuations. Mark my words, people are going to these alternatives, and it's going to be a steady stock, in my opinion, throughout the health situation. They have a market cap of $7.785 billion. They don't report a PE ratio due to income loss and don't pay out a dividend. They have a price to book of 20.40. They have a forward PE of 625. I know this is incredibly high. They have a bad profit margin of minus 1.12%. They have a bad return on equity of minus 1.71%. However, they do have a decent amount of cash with $246.41 million and a current good ratio of 5.78. They have greatly increased their revenue from 2018 to 2019 from 87 million to 297 million. However, with this, the cost of revenue also greatly increased. They did generate profits both years. However, their operating loss chewed into this, resulting in a net income loss of 12.4 million. What's really important here is their increasing revenue. It has increased every year from 2016. They had generated more than $250 million in 2019, and their trailing 12 months, they're already at 354, showing an additional increase. I really like this increase in revenue. It's showing that they're on the right trajectory, and I can only see this increasing in the coming years. However, I do think this stock is currently a bit high, so in the month of August, I hope this will come down to about 90, where I would see it as a much better price entry point. All right, moving on to a company you're all probably familiar with, Shopify. They were the Cinderella story of the stock market the past year. They're up 176% from last year, which is absolutely mind-boggling. And until quite recently, were seemingly on an unstoppable surge. They are primarily an online e-commerce store, however, are slowly moving into the payment sphere, which are two extremely well-positioned industries to be in during our current climate. If you bought shares, let's say in 2017 or 18, you were probably jumping in joy throughout the past year. They have currently seen somewhat of a loss in valuation the past few weeks, which is making Shopify increasingly enticing. I know it is an extremely pricey stock, but I think if you do have the funds, it will be a great long-term buy. If they continue trending down in August, perhaps to the 800 USD price point, Shopify, in my opinion, would be a phenomenal buy. The world is increasingly moving online, and with the current health situation potentially worsening in the coming months, many businesses who've already opened up their doors may unfortunately be forced to close their doors and move back onto the online space. You can kind of see an inverse correlation with the health situation and Shopify stock. This shutdown of businesses would drive more traffic to the online store, generating additional revenue to Shopify's already phenomenal balance sheet. I also think that once people become accustomed to shopping and buying online, they generally tend to stay there rather than going back to a brick and mortar, conventional, traditional store. They feel more comfortable operating within the online sphere. Many previous storefront owners are realizing that they don't need to spend all this capital actually having a brick and mortar tangible store anymore. They can operate online, greatly reducing their own overhead. I can really only see this increasing in the coming years and decades. Going to their balance sheet, like I said, it is very expensive. It's currently 929 USD on the NYSE. It is a volatile stock at 1.61. They have an EPS of minus 1.15, a massive market cap of 110 billion. They don't pay out a dividend and are extremely overvalued. It's important to note that most tech stocks that are doing well are overvalued, yet this is just the world we live in now. They have an absolutely insane PE of 5,000, have a price to book of 37, a return on equity of 5.11. They generated 1.73 billion in revenue, and they have 2.36 billion in cash with a current ratio of 9.45. It's obviously an extremely expensive, very overvalued stock, but investors are pricing in the future landscape. Investors are realizing the importance of the e-commerce world and how Shopify is an actual competitor to Amazon. We could see what happened to Amazon stock, and I think many investors are pricing in similar trajectories in the coming years to decades for Shopify stock. All right, let's turn to everyone's favorite, speculation. I wanted to throw this one in, however, I did put it at the end and with an asterisk. Although all stocks are essentially just a bet at the end of the day, this stock is a massive bet. The company I am talking about is Carnival Cruise Lines. Buying the stock essentially comes down to two factors. One, will the health situation be under wraps before Carnival Cruise Lines goes bankrupt? And two, if Carnival Cruise Line is still afloat, see what I did there? If they are still afloat when the health situation is under wraps, will people gravitate back to them? One of these factors, in my own personal opinion, can be very easily answered, and that is number two. People, in my opinion, will gravitate immediately back to cruise lines. If there's one thing old people love more than anything, more than their grandchildren, it's taking cruises. I've never been on a cruise. It's nightmare fuel for me. I don't know why people love them, but people love cruises. Okay, so going through their stats, CCL is a large cap company with 11.592 billion in outstanding shares. They're currently very volatile with a beta of 1.97, have a massive 52-week range with a high of 51.94 and a low of 7.80. They obviously aren't reporting a PE, have a negative 4.25 EPS, and essentially have no cruises operating currently. Carnival's only move right now is to slash their operating expenses as much as possible. This is why they've completely cut out their dividends, which used to be a huge enticing point to this stock. It was near 6, I think, at one point. They have furloughed and laid off many staff. They're cutting insurance, payroll. 62 of their ships are already traveled and sitting in their resting ports. They have completely cut out marketing, and they are currently obviously on a hiring freeze. The company does, however, luckily have a good amount of cash on hand to get them through at least the next year maybe. They have $7.6 billion of available liquidity and are increasing this number through refinancing scheduled debt maturities. They also have $8.8 billion of committed export credit facilities. They are expecting a cash burn rate of $650 million per month throughout the second half of 2020. This is absolutely astounding. The basic concept here is that they are absolutely hemorrhaging cash on a daily basis. It's insane the amount of cash burn they're going through. Purchasing this stock is essentially betting that the health situation will be under wraps before this company does go bankrupt. They are going to go so far into debt, and it's going to take them a few years to get through it on the other side. If you do purchase this stock, make sure you are willing to never see this money again. However, if they do make it through this, and I really do hope they do, I can see this bouncing back in 5 to 10 years. People down the line might say, wow, that was an insane entry point for this stock, but it, at the end of the day, is a bet. And you need to be willing to not see that money again. Don't use any money for the specific stock that you need. It is essentially just a bet. There is a lot of upside, but there's also a lot of downside. More risk, more reward. That's the name of the game. Anyways, guys, thanks so much for watching. I hope you didn't mind my party shirt too much. Thanks for 500 subscribers. I really do appreciate it. I'll be wearing this guy again for 1,000. I think I'm gonna do a video where I try to do 1,000 push-ups for each subscriber when I hit 1,000. Who knows if I can do it, but I'm just going to. Whatever. Anyways, thanks for watching. Please hit that subscribe. If you haven't already done so, hit the like for that YouTube algorithm. Really helps out the channel. Anyways, guys, thanks so much for watching. Thanks for 500. I'll see you guys next time. Cheers.